Hey guys, I think this video might upset some people because I'm going to defy some conventional wisdom when it comes to investing. In this video, I'm going to tell you which of these strategies is the best. Buying at all-time high, buying at a pullback of 10, 20 or 30%, or just blindly DCA every month. And I'm going to show you this for different ETFs. So, before we start, which strategy do you think is the best? Buying at all-time high? Buying when there is a pullback of 10 or 20 or 30%, or just blindly DCA every month? Let me know in the comment section before you start watching this video, the rest of the video, which strategy do you think is the best? Because the data might be, it's against the conventional wisdom, let's say. Okay guys, without further ado, let's get started. So for this video, we are going to be basically looking at 10-year periods, and over these 10 years, every month the strategy has $100 available. And the all-time high strategy, these $100 are deployed every time there is a new all-time high. So if the market is in a bear market, it will not buy anything, and only when there is a new all-time high, the strategy will place a buy order, okay? Then you have the pullback at 10%, pullback at 20%, and pullback at 30%. In these three different pullback strategies, these $100 that you get every month are only deployed, only you press the buy button when there is a pullback of 10, 20, or 30% respectively. And then the fourth strategy is simply regular DCA. Every month you receive $100, like you receive your salary and save some money every month, and you just put it in the market, okay? So which one do you think is the most successful? The data is very impressive. So let's jump here on the chart. Okay, and what we have here, I started with VOO, the S&P 500, Vanguard S&P 500 ETF, one of the most popular ETFs out there for people investing their money. And guess what? Regular DCA, just blindly DCA over the last 10 years would have yielded the best returns, 140% returns. So in all these strategies, we got $12,600 over a period of 10 years, $100 per month. And it seems that really the best strategy was simply DCA with 140% return. And actually, the second best strategy, this is impressive, the second best strategy was buying at all-time high. And why is that? Well, buying at all-time high means that you are buying when the market there is momentum in the market. And usually, more all-time highs come after all-time highs, right? So actually, buying at all-time high beats, in the S&P 500, beats buying at a pullback of 10% or 20% or 30%. And there are a couple of good reasons why buying at all-time high beats waiting for a pullback. First, like I said, all-time highs are usually clustered, and if you are in a bull market, the markets keep giving you all-time highs. This year alone, we had many new all-time highs. And fun fact, over the last 10 years, we had 310 all-time highs. Having all-time highs doesn't mean that you are not going to have all-time highs more in the future, right? So some people come to me and say, I don't want to invest now because the market is doing new all-time highs, and the data that I'm showing you in this video proves that actually investing at all-time highs is not that bad, okay? Then let's jump here again on the chart, and impressively, waiting for a pullback of 10% or 20% or 30% yielded less. So actually buying at all-time high would have returned 132%. If you wait for a 10% pullback, you get a return of only 120%. If you wait for a 20% pullback, you get 122% return. And if you wait for a 30% pullback on the S&P 500, you get 104%. Another reason why this happens is that when you are waiting for the pullback, you are sitting in cash. So as you can see here in the deployed column, the lower the pullback that you are waiting, the less you have deployed, because now you're just waiting in cash. This, cash is a melting ice cream. You are losing money to inflation, and there is an opportunity cost, right? Opportunity cost because if you are not in the market, you are missing the bull market, right? And as I've been saying a lot, Bull markets on average last 7 years, while bear markets last on average 7 months. And like the great investor Peter Lynch said, more money has been lost waiting for a crash than in crashes themselves. So I prefer not to wait for a crash and just keep investing. And by the way, if you want to learn all about my investment strategies, check my Henry Clout Academy, link in the description. You have a stock market investing course that I just finished recording. It's almost 6 hours talking about stock market investing. You also have my leverage ETF course where I talk about everything about leverage ETFs and how did I manage to retire in Hong Kong just by investing in leverage ETFs for 6 years. You have a 7-day free trial to join the community. So you can join the community, link in the description. You can leave before the 7 days and you don't need to pay anything, okay? But I guess you will stay because the content is really good. I share everyday content with my community. Okay, back to the chart. So as you saw here, in the S&P 500, just blindly DCA will be the strategy number 1. In investing at all-time high will be the strategy number 2. Then it's followed by a pullback, waiting for a pullback of 20%. What about QQQ? QQQ is basically Nasdaq 100, is a little bit more volatile, but yeah, the results are also pretty similar. Regular DCA in investing in QQQ will beat 234% return versus all-time high 219%, and waiting for a pullback of 10% will give you 218%, pullback of 20%, 214%, and pullback of 30%, you'll get half of the returns of the regular DCA. You'll get only 117%. Very interesting data here, right? What about stocks? Will the same work for stocks? Let me put here Amazon, for example. Amazon is a stock that over the last 10 years did quite well. And yeah, it seems that Amazon also the same. Regular DCA, blindly investing $100 a month into Amazon will give you 165% return. All-time high will give you 142. In the case of Amazon, actually waiting for a pullback of 10% will give you the best returns. Will give you 152%. Will give you actually better than all-time high. So in the case of Amazon, actually buying at all-time high will not be exactly the best. Waiting for a pullback of 10% will be the best. But the difference, honestly, is not very big. So again, regular DCA wins the strategy. Now, I want to look at leverage ETFs. And there are many different leverage ETFs we could look at, but QLD is the 2x Nasdaq, and it's one of my biggest positions at the moment, is QLD. In QLD, we have here very interesting data. Regular DCA, 588%. This is a big difference when compared to the S&P 500 numbers that we just saw, right? 588% for regular DCA. Buying at all-time high, people, for you guys who are concerned about buying at all-time high gave you 524% return, okay? And actually, the only strategy that was better than buying all-time high would have been waiting for a 20% pullback. But waiting for a 20% pullback in QLD will give it just a little more, 531%. Just a little bit better than just buying all-time high. So again, I will not be concerned about entering leverage ETFs at all-time high. Of course, you will allocate less, okay? Leverage ETF should be a satellite component of your portfolio, but a satellite component that can grow really a lot. So for some people, leverage ETFs can be 5% of their portfolio, 10% of their portfolio. For me, because this is my life, I do this every day. For me, it's 50% of my portfolio is into leverage ETFs. But I do this every day and I manage a hedge fund. So this is my life. For you, if you want to be a bit more conservative but still have that big upside of leverage ETFs, 5 to 10% is perfectly fine. And again, I think you should check my community, Henry Clout Academy, because I talk about leverage ETFs every single day. I share my strategies, I share my trade alerts, and you can really learn so much about leverage ETFs. Okay, I want to talk about one more leverage ETF, which is UPRO. So UPRO, what will be the best? UPRO is actually one of my favorite leverage ETFs. UPRO is 3x S&P 500. There are tons of data that show that if you have used 3x leverage ETFs for the last 70 years or so in the stock market, 76 years, okay? 3x S&P 500 will be the ideal. Of course, in 1950, 1960, there was no such thing as leverage ETFs, but people backtested this stuff. And there is lots of research that shows that 3x leverage will be the best. I'm not saying that you should do 3x leverage at this precise moment, okay? I share my strategies on how to do this, but on the way up, there is more risk build-up, you decrease your leverage. And then when the market comes down, you can increase your leverage. And you can DCA by using leverage ETFs. That's why at the moment, I have 2x leverage on average. And if the market crashes tomorrow, I can DCA using increasing my leverage. Okay, but what we see here, UPRO, again, the best strategy will be DCA. And then, actually, I'm very impressed to see, but the pullback 30% would beat the buying at all-time high or pullback 20% or pullback 10%. So actually, for leverage ETFs, you can always leave some cash on the side. At the moment, I have some cash. I don't have any problems to say that at the moment I have, as part of my leverage ETF portfolio, I have around 20-something% in cash, okay? And this is one of the ways I achieve 2x leverage, because I have a mix of 3x leverage ETFs, I have 2x leverage ETFs, and then I have a component of cash. So if there is a pullback, I buy the dip. And actually, as you can see here, UPRO, if you just wait for 30% pullbacks, you actually get pretty good results, 369%, versus buying at all-time high, 343% over the last 10 years. Of course, again, DCA would be the best strategy. Finally, the last but not the least, I think you guys love TQQQ, and I think like TQQ is really one of the favorite leverage ETFs of everyone because it has been performing so crazily. Okay, I already said this a couple of times in my past videos, but let me repeat one more time. And let me know if you know the answer in the comment section. Do you know how much will you have to invest in the TQQQ 15 years ago to now have $1 million? Okay, to now have $1 million, how much do you have to put in the TQQQ 15 years ago? Take a guess. Did you say 50,000? Nope. 10,000? Nope. $3,000. $3,000 in TQQQ 15 years ago will now be $1 million. This is why I leverage ETFs. The best risk-adjusted returns, best compounding growth. Anyway, looking at the chart, what we see here is, again, regular DCA beats any of the other strategies, 947% over this 10-year period. While the second strategy would be a pullback of 10%, but actually very, very similar. As you can see here, buying all-time high, pullback 10%, pullback 20%, and pullback 30% will be very, very similar in terms of returns. So basically, the conclusion of this video is don't be afraid of buying at all-time high. All-time high means that we are in a bull market, and after new all-time highs, usually you have more all-time highs. If you want to have a little bit of cash on the side and buy the dip, buy the pullback, you can also do it. That's also fine. But the best strategy that you can do is just regular DCA. Always buy every month. You have a job, you receive a salary, or you have a business, you make money every month. If you can save $1,000, I would put aside part of that money to put into leverage ETFs. It can be $100, $200, $500, doesn't matter. Most of the brokers nowadays allow you to invest as little as $50. So there is no excuses not to invest. Open a brokerage account and start putting every month whatever you can put, a little bit, $50, $100, $500, $1,000, depending on how much money you can save. But I'm pretty sure that 10 years from now, you will send me a thank you cards because you have potentially made $1 million and achieved financial freedom with leverage ETFs. Okay, guys, if you enjoyed this content, give it a like and subscribe, and check again the Henry Pelt Academy 7-day free trial. You can cancel anytime, no questions asked, and I think you can really benefit a lot from it. I do this because I love sharing investment strategies that can really help people. All right, I'll see you in the next video. Bye.